Hello everyone, welcome to our discussion of Chapter 3 and literally what is included on the tax return as taxable income and what does not. That's really what Chapter 3 is about. And sometimes it's not so much whether it will or not, is when as to the time period. Okay, so this is very similar to the concept of recognition in financial accounting, but we're talking about it for recognition. And when we say recognize, that means it's put on the tax return. So that's what the term means, recognize income in a tax sense. When we talk about it in a financial accounting sense, we put it on the financial statements. So it has a similar meaning. So for it to be income, it has to be realized. I mean, you have to receive something, and we have to earn it typically, okay? And so it must be recorded, and then it will be recorded on the tax return. And really, our definition of income is very broad in the tax law. Basically, anything that brings benefit to the taxpayer is considered income. Only things that are specifically excluded can actually be left off. So, for instance, just an example, if your employer provides you with something other than the salary, so the salary is an obvious thing, but something else, say they pay for you to go on a trip, that's income to the employee. Even though they didn't receive any cash, they received a benefit. Okay, so we have to be very broad in our definition. Only if the law says that specific situation is excluded do we get to leave it off. All right, so we're looking at that economic benefit. We want the transaction, that trip, if you will, that I just described. Okay, and then there's possibility that it could be in the law that it's tax exempt, that there is no tax, it is not recognized on the tax return. Now, one important concept, most folks, most individuals, almost all individuals, are on what's referred to as a cash receipts and disbursements method. So we are applying that situation or the idea of recognition to when we actually receive the cash. So not if we do something in 2021 for someone but receive the cash in 2022, then if you're on the cash receipts and disbursement method, which almost everybody is, then you're going to recognize that as income put on your tax return in 2022 when you actually receive the cash. Unless, of course, there is something in the tax law that says otherwise. So that brings us to the rule of constructive receipt. The income reported in the year we received the right to control the income. So it goes a little beyond actually receiving the cash. We also have the idea of constructive receipt in the sense that if someone mailed you a check and you received it and have it sitting there, but you don't take it to the bank, it is still income in the year that you received it, even though you didn't put it in the bank and it isn't actually deposited. Because having it there under your control is constructive receipt. Just postponing taking it to the bank doesn't postpone it to a new year. That's the same thing with receipt of any property or services. All right, it's going that when we actually receive the benefit or have control over it, then that is when it gets recognized. So how does this apply to some of our main, you might say, types of income? First of all, we want to talk about interest. Interest from banks, other types of financial institutions. you're going to get a 1099, although the IRS has allowed these institutions to not send them if your income from them is less than $10. All right, so they have to send out lots of really small amount 1099s, and that was a pain. And so they have stopped doing that. That does not mean that you don't have to report it. It just means that you're not going to get confirmation from the bank. All right. Savings bonds is taxable on the federal level. Unless there is very specific use of that for educational purposes. But absent that situation, that mentioned in the tax law, the interest can be reported, and you get your choice whether to report the income gradually as you earn it, or at the end. So most people are going to wait till the end. Most people are going to have a savings bond, and savings bonds, for instance, you pay $50, and then at the end of 10 years or 20 years, you cash it in for $100. Okay, that's the way a savings bond works. Now, what's happening every year is it's getting closer and closer to 100. So that part of that interest can be included in your income each year that you earn, or you can wait till when you cash it in and you report all $50 of the income. Either way, it gets recognized. Now, one important, very important exception in the tax law is interest received on the debt. You buy bonds from the state, county, city government, school district, any of those, and you earn interest on that investment, okay, then that is tax exempt, which means while there is a place for it on the 1040, kind of off to the side, because it is, the IRS wants to know how much it is, but it's not included in your income when you add it up your total income. Those are tax exempt. So be aware of those. That's specifically in the tax law. Other interests that you might come across when you're preparing tax returns, if you sold your house and they are paying you over time with interest, okay, they didn't get a loan, that would be a seller finance mortgage, and you would have interest income on that. Anything you sell over time to someone else would have interest, may even be imputed to you, because you charge a lower rate than what's legally responsible. All of this gets reported on the tax return, specifically on Schedule B, if the interest is more than $1,500. All right. So and then you would designate when you put it in the tax form in the Tax Act for preparing tax returns. You put it on Schedule B, and then from the total from Schedule B goes to the 1040 to show how much interest was earned. Dividends feel a lot like interest, okay, but they have there's some differences. First of all, remember, dividends are the company sharing the profits that they made with the shareholders. They are generally income, okay? If they are qualified dividends, and most dividends they come from corporations out of their retained earnings. Qualified dividends, and this is an important distinction, are part of income. So they haven't been designated by the tax law as tax exempt, like some forms of interest. So no dividends other than those on tax-exempt bonds like we talked about in the last slide are actual tax-exempt. They still get included in our income calculation, but they may have a 0 tax rate on them. But that does not mean that they are excluded from our income. So this slide tells us the specifics. Now we know that there are tax brackets for regular income we've talked about in chapters 1 and 2. And we've used them to calculate the tax on people's regular income. There are different tax brackets that cover qualified dividends. Now, if there's not qualified dividends, for instance, dividends paid on a mutual fund, those are just income, period. Regular income. But if they are qualified, then they have this very specific 3 tax brackets. Meaning, like I said, you could have a tax rate of 0 on qualified dividends if your income, right, is under $80,800 if you're married filing jointly. And the dividends would be taxed at 15% if your income is all the way up to $501,600 for married filing jointly, and then 20% over $501,000. So you've got to have lots of income to be paying the 20% tax on just the qualified dividend part of your income. Your other income is calculated using the tax rate tables we learned about earlier. So this is kind of a complicated thing here, that we have the 2 tax, you might say, bracket lists, one for dividends, qualified dividends, and a different one for regular income. So what you're going to have to do is you have qualified dividends. You literally have to calculate the tax twice and then add it together. So you have to see, and you have to count all your income when you're talking about these tax brackets you see on this screen. It's not just the qualified dividends, which makes it actually even harder to figure out. You have to count all your income, figure out where you are, but then apply this tax rate just to the qualified dividend part of that income. Now, on the bright side, stock dividends that are paid entirely in stock, you don't get any cash, or stock splits are not taxable to shareholders in almost every case. They go also on the Schedule B if they're more than $1,500. Okay? But remember, unlike interest, your qualified dividends, okay, and your dividends, so what you're going to enter into software, what they want on the tax return is all the dividends and then the qualified part too, okay? All dividends are part of income. The qualified dividends are part of income, but also need to have a different tax rate, potentially. So make sure that you enter both when you're using tax software, both the qualified and regular. If all of them are qualified, it does seem redundant, but that is what you need to do. You need to list it as regular dividends and as qualified dividends. All right, tax refunds. Money back from, and we're talking about from the state government. You overpaid your state income taxes, and therefore you need to, then you get a refund. the next year. Okay? So the question is that refund, is that income that should be put on your tax return for the federal government? Note that federal refunds are never taxable. Federal taxes are never tax deductible. So this is entirely about state and local taxes. So the question is, did you get a benefit in the year before? So you overpaid your taxes in 2020 and you get a refund in 2021. It's always going to be a year later, maybe even 2 years later. But let's say in this case, it's you get your refund in 2021 for overpaying your taxes in 2020. The question is, in 2020, did you get a benefit? Were you able to use that state income tax you paid as an itemized deduction? If you were not, because you didn't itemize, you didn't choose itemized over the standard deduction. If you use the standard deduction in 2020, then you didn't get any benefit for paying in taxes, so you shouldn't have any income when you receive the refund. If you paid enough in state income taxes such that you went over the amount of the standard deduction, then the amount over the standard deduction from the previous year is one number you need to consider. It's either the lower of the amount you went over or the refund you receive. Always remember, you're considering what the standard deduction was in the previous year, not the current year. So when you're considering the refund you received from 2020 in 2021, you're comparing what happened in terms of your standard deduction versus the itemized deduction for 2020, not 2021. Now, Social Security benefits have a fairly complicated way. What the situation is with Social Security benefits, receiving them, is that they are always going to be partially recognized. Now, on the 1040, what's going to happen is you're going to put the total amounts you get, and then you're going to calculate how much is actually included in the income. So there's going to be two boxes for your Social Security benefits. All right? And so we have to go through this process of determining how much Social Security benefits are included in your income, total income. It will never be 100%. It will never be all of it. The maximum it can be is 85%. And it depends on your income. Okay? So you have to calculate, to figure out how much of your Social Security benefits are taxable, you have to calculate provisional income. Now, provisional income, all right, is AGI, adjusted gross income. We've seen that before, okay, that calculation. And it doesn't include your Social Security benefits. So for the minute, you've left that out. And then you add back, okay, some things that normally are not included. And this is the most important one. The most tax exempt interest is added back. And then you put in your 50% of Social Security benefits. Okay? And this deducted tuition fees has gone away for 2021. So that's how you get provisional income. Then the idea is, if your provisional income is over one threshold, you're going to have up to 50% of your Social Security benefits are taxable. As it if you're over another threshold, you could have up to 85%. Here are your thresholds. These haven't changed in decades. Okay, so unlike much of the tax law, this has not been indexed to inflation. This does not change. So the threshold is $32,000 for married filing jointly and $44,000 for the second threshold. And for single, head of household, qualifying widower, they all use the same, 25 and 34. So what you're going to do is basically, if your income, provisional income, is between 32 and 44, and married filing jointly, you're going to have 50% of your, roughly 50% of your Social Security benefits maximum taxable. If your income's over 44, then it could be as much as 85. All right? Same thing applies for the other side to the other filing thresholds. So, an example. It's not quite just take the 50% or 85%. You have to actually consider how much over the threshold you are. So Karen files a return as a qualifying widow. She receives $7,000 of Social Security benefits, $19,000 of interest income, and $5,000 non-taxable. Her provisional income, adding 19 plus 5 plus half, is $27,500. She'll report as income the lesser of 50% of her Social Security benefits, $3,500, or 50%, and this is the issue with how far over the threshold you are, 50% of the excess provisional income over $25,000. So she's over the threshold. She's single, remember, she's not married filing jointly. Okay, so she uses the 25 and 34 that we saw over there. She's over the 25 by 2,500, 27,500 over 24. So half of that is $1,250. That's lower than half of her Social Security benefits. So she includes the $1,250 in her income. And once you get past the second threshold, you're going to compare 85% over the amount of the threshold, compare plus 50% of between the two thresholds to the 85% of the total benefits. Same way. Other types of taxable income that you might not think about: jury duty. If you get paid, if they get paid you like $12 a day for jury duty, you'll get a reporting from that, and that's income. There are ways around that if your employer pays for it, things like that. But prizes and awards, you win something, all right, that is income. Forgiveness of debt, kind of a crazy one. You owe on your credit card, you declare you have a financial problem, you get your credit card company to forgive that. That is actual income. You have to be careful because you certainly don't have any cash in hand to pay the taxes on that. And if you have a problem with your house or your car and it gets stolen or whatever, or it gets broken or in some way is damaged, and they pay the insurance price, it gives you more than what you have put into that, you could have a gain. You could actually have income in that situation. So that's the situation with what's included in income. In our part 2, we'll consider things that are excluded from income.